Hey guys, Jim Vinosky with Manufacturing Talks. We got a different one for you today. It's about real estate, specifically manufacturing real estate, of course. I've got Aaron Halfacre with us. He is the CEO of a company called Modiv. They are a real estate investment trust and they invest in manufacturing properties. So Aaron's here to tell us why he does that, what it does for him, what it does for the manufacturers. Really interesting stuff. So stick around. Aaron's joining us in just a minute here on Manufacturing Talks.
Welcome to Manufacturing Talks with Jim Vinosky. Industry has a million cool stories, and Jim talks to the movers and shakers who are making them happen. Let's dive in.
Hey, everybody. Welcome back to Manufacturing Talks. I'm Jim Vinosky, your host. Glad to have joining with me today Aaron Halfacre. He is CEO of a company called Modiv, and we're going to dive into what that is and what he does. Before we do, I want to hear all about you, Aaron. Welcome.
Jim, thanks for having me. I really appreciate it. And I'm just honored to be able to speak to your audience.
Well, thank you. We're honored to have you.
Yeah. So at Modiv Industrial, we're listed on the New York Stock Exchange, ticker's MDV. I've been in this role for about 5.5 years now, but I've been in the industry, the real estate industry, for about 25 years. And, humble beginning, first person in my family ever go to college, first person to go to graduate school, and have just been plugging away in this industry that I didn't know anything about for a long time. And then it really, probably in the last 4 or 5 years, finally feeling like I've started to master my craft. Modiv is a company. It's a publicly traded REIT, so it's a real estate investment trust. It pays monthly dividends. And what we do is we only buy industrial manufacturing real estate. So we buy from proven manufacturers on long-term leases. That's what we do.
So let's go back to a couple things. First, you talked about getting into real estate 25 years ago. What was it that took you that direction?
Yeah, so I've been around. I've lived in a lot of places. I've been in like 15 different states. When I first was born, my dad was in the Navy and during Vietnam. We moved around a little bit then. And, I grew up in the Midwest in Indiana, where my dad, he got out of the Navy, was an electrician. And then he worked at manufacturing plants and eventually became a maintenance supervisor, bumped around a little bit. Then, my parents divorced when I was a kid, like a lot of people did. And I somehow, on a lark, my mom, my sister, and I ended up in Hawaii. I was in Hawaii for high school, and that's where I decided I wanted to get into real estate. So I got my real estate license really early. This is back in the day, I'm dating myself a lot, but you'd print out on dot matrix printers labels to do bulk mailing. And so I did bulk mailings, did things like that. And so I started out selling duplexes and fourplexes, sort of investment properties, if you will, on the light end to Japanese investors this was back when the Nikkei and the yen were really strong and they were just coming into Hawaii and buying things. And after that ended, I joined the military. I was in the Air Force for a little bit and just was a little bit lost. No one really told me to go to college or anything like that. Didn't go to school until I was probably 26. I started going to undergrad, and then I plowed right through that in 2 years, went on to graduate school. Worked as a stockbroker for a little bit, but missed real estate. And so when I had the chance, when I worked on Wall Street, I kind of gravitated towards it. And the last 20 years, formally, professionally, after all that education and stuff like that, has been, I've worked for BlackRock for a decade when they were a small company. Now they're huge. I've taken a REIT public, sold that REIT to someone else, took a REIT private, and then, joined this company about 5.5 years ago. And we listed on the New York Stock Exchange about 2 years ago. So, done a lot of different things, been a nonlinear path in my life, from making pizzas to working at a chicken factory in West Virginia to getting to do this stuff. I really find it's a journey, and you never know what you're going to learn the next day.
Yep. Yeah, very interesting. And then you talked about Modiv being a REIT, so real estate investment trust. Tell us a little more what that is, what it does.
Yeah, for those who don't know, a REIT is a stock. It's a company. It's publicly traded. There's publicly traded ones and there's private ones that are non-traded. We're publicly traded. The real estate investment trust legislature actually goes all the way back to 1960. So the REIT construct's been around for a long time, but the modern REIT era, where modern day REITs existed, really started about 30 years ago. About 1992 was the first one. And REITs are basically a very liquid form, public form of full transparency for an investor. If they want to own real estate, but they don't want the headaches of real estate, it allows them to, to own real estate in their portfolio, their Schwab account or their Fidelity account, and go from there. So it's really an interesting concept. And what we do is we buy real estate on long-term leases to these manufacturing tenants, and they pay us rent. And then we pass that rent on as a form of a distribution to our investors. We do a monthly dividend. That's what Modiv stands for. And we pay a monthly dividend. And then at any point in time, that investor can just take their shares and sell them if they need the money.
Yep. Yeah. So you guys are the owners of the properties you purchase, and then the people who buy your shares get to participate in the real estate market without direct ownership, right?
Without direct ownership, without having to deal with toilets, without having to deal with trash,
Yeah.
without having to deal with the headaches that when you're a public real estate ownership, you get maximum liquidity compared to if you do it privately.
Yeah.
You get a lot of transparency, probably I would say the best level of transparency, because we're required by the SEC to do public filings every quarter. And, you'll find us to be transparent and believe in that. So you get that. But what you don't get is you don't get control, right? You can control it with your shares. You do get to vote as a shareholder, but, you can't decide if the paint on the property is going to be pink or blue or something like that.
Right. Yep.
Yeah.
Okay. And then you said Modiv in particular chose to specialize in these manufacturing properties. So what is it about manufacturing that had you focus there?
Yeah. So, if you look at the spectrum of real estate, there's a lot of different things you can own. And if you think about real estate, primarily has sort of three broad category purposes. One is for people, one is for things, and one is for information. So if we think about information, this is a relatively new space. That's data centers, that's cell towers. There's real estate that houses the transfer or storage of information. The more traditional one that we always knew about for time eternal has been with people, right? So apartments or single family housing or hotels are designed to house people, right? Office buildings, which has always been the debate now, is for people to use as a shelter during the day to go work. I categorize a lot of the biggest bucket, though, is the thing that has to do with things. And we think about retail. Retail is actually for a retailer to sell things to people, right? It's not to house people. People don't stay overnight in these retail locations, but the things that they sell do. So there's stock full shelves. We've got storage that, is after you bought the things and you don't want to get rid of the things, you put them in a storage unit to store the things. And a big part of American real estate is about the consumption of things, right? We got dollar stores and strip centers and malls and things like that. But what we are is this unique category, and we're the only ones who are exclusively focused on this, of where things are made. So the real estate where we actually produce and make things within our nation. And what we focus on in that is, these real stalwart, survivorship biased type of things, been around a long time, manufacturing capabilities that are critical, right? So aerospace, defense, medical, some automotive, infrastructure-based types of things that you're not going to find on Amazon, things that you're not going to find in a strip center, things that are sort of critical to our nation. Those are the types of manufacturing that we are drawn toward. And we think this is a good asset class for a lot of fundamental reasons that I'm sure we'll talk about today. But, we've been underinvesting in this space as a nation for 30 plus years. And now we're starting to see more and more headlines about what has already started and is underway of this reinvestment in the manufacturing capabilities.
Well, and it's interesting because your name came to me coupled with Harry Moser. And it just so happened when I got that communication, I had just finished interviewing Harry for the show back a few episodes ago. And of course, he's with the Reshoring Initiative. And I saw where you had commented quite a bit as well about what you just said. We are seeing manufacturing coming back to America. And you're obviously very bullish on that. What is it that has you looking at that so positively when it has been sort of the other way around for a few decades here?
Yeah, I remember in the late 90s when I went to business school that my professors would teach us the global just-in-time delivery model, right?
Yep.
And it was this concept where as a smart, savvy corporate manager, you can arbitrage labor markets globally and reduce your cost of goods sold, and everything will just get delivered. And that's the mantra that's been utilized in the US since the 80s, right? So if you go back, if you ever read the History of Capitalism by Alan Greenspan, it's a wonderful book, and he talks about U.S. capitalism and how it's changed and how it's evolved. But the mentioning of manufacturing is so prominent from our earlier colonial days all the way up until post-World War II. The fact that we were a strong manufacturing nation led to so many benefits for us and creating us what we were as a superpower.
Right.
During the late 70s, we started some of the conglomerates starting to move over, but really it was Eastman Kodak in 1989 who outsourced manufacturing to a third party offshore that really started, for some reason, got the flywheel going. And then it wasn't, China has been the primary beneficiary of that over the last 30 years, where they've created tons of manufacturing capability. They had cheap labor. That wage disparity isn't as much as it once was.
Right.
But what we found, and that was fine, and it was working until it didn't work. And then a whole series of events have happened in the last few years, sort of black swan events, where you had COVID-19, where we saw huge supply chain disruptions. Then you had the invasion by Russia of the Ukraine, which created additional supply, because a lot of people don't realize that we got a lot of things from Ukraine. Then you have recently, you've seen articles about the Panama Canal and how there's not enough fresh water to pump in and out. So they're slowing the rate of shipping around there, which requires you to go around a very longer route. So that's a disruption. And now, most recently, is the Red Sea Suez Canal attacks. And so the supply chain model that we relied upon for 3 decades is showing vulnerabilities. And that's fine for some non-critical things, right? If there's a cycle where your replacement cycle for something is not critical and you can get it far cheaper 9 months later, and you don't care if it's 9 months or 12 months or 6 months, that works. But there are certain critical components that are essential, and what we're finding is people are saying, as corporate managers saying, look, I will pay a marginally higher cost of goods sold, and they're finding that it's marginal, it's not extreme, to have it domestically manufactured. So where I might have been sourcing it over here, I will have it sourced here, and I will have it produced here, so I can rely upon it. That's essential for aerospace, defense, medical, certain infrastructure things that we can't be beholden to someone else to deliver. Right. And I think what we're realizing is that underinvestment, it was fine for capitalism to underinvest, but too much of a good thing can spoil it. And we've realized that we've weakened ourselves as a nation, both politically, defensively, and as a good trade partner, right? And I think that's the primary reason why we like it so much. We think that the rhetoric, though it's a little bit politicized right now in the current cycle, it's real, it's here to stay, and it's viable. And I think no matter what presidency we have, that people understand that having the manufacturing capability at a certain critical level is just sort of good business.
Yeah. Yeah. And I love what you said about the just in time. Very similar to what I've said a number of times, is that it worked great while it worked great. But then we had those disruptions you mentioned, and all of a sudden people realize it's really not set up for dealing with when things aren't going so well.
Right. Yeah. And I think that's where there's a unique opportunity. It's a unique asset class. You have to, when we're buying it, you have to buy it right. There are pitfalls in this space. So you have to try to buy it as right as you can. The buyer pool right now is the number of buyers is limited because people have, they had forsaken it for so long. And now, I just saw another article today about it. So I'm pleased to see these articles. Our view is that we will benefit no matter what. I agree that a rising tide and the rhetoric about reshoring is a positive, and I think it's here to stay. But it could ebb and flow depending on the nature of things. And I think the critical manufacturing facilities that we have that have been around through Volcker and Greenspan and Bernanke and Powell, and who have survived outsourcing for these lives are viable, and they will only be more viable and more valuable as time goes on.
Yep. So let's kind of look at it from the other side. What does what you guys do bring to those manufacturers who are then leasing the real estate from you?
Yeah. So they do lease it from us, and they do it in what is called a net lease format. So absolute triple net lease. And that is if you think about net lease, there's, Realty Income and WP Carey, and there's a lot of great net lease REITs out there. And most of them own, dollar stores or Walgreens or maybe some fast food restaurants. And sometimes they own manufacturing, but they didn't always buy manufacturing the way we think about it. We think about it as a dedicated asset class. So we're not looking at just the yield. Like this one yields 8 and this one yields 7.5. So I'll buy the 8. Well, the 7.5 credit might be a far better one, right? It might have a more durable type of product they're manufacturing. They might have a greater market share. They might have all their businesses in this one facility. So what we're looking to get is a real durable type of product that we understand the market cycle to, that we can relate to what they're manufacturing and how viable it will be in this economic cycle or a future one. And I always try to engineer for a worst case scenario. What could go wrong? The worst thing scenario with the manufacturing is that they no longer want to manufacture there, right? Because these buildings are, look, they're not beauties, right? They're just,
right. Yep.
They're not in prime locations necessarily. And
Right.
so you want to make sure that your manufacturer wants to be there. But the reason why a net lease model works so well is these have tended to be on their balance sheets for 20, 30, 40 years. It's their golden goose that lays their golden eggs. And so they do, to allow it to give it to someone else and have to be a tenant and have a landlord, that's a delicate dance. And so the absolute triple net model requires, so they take care of the maintenance, they require the insurance, they run it as if it's theirs, and they give us a payment. Normally how these are initiated is what is called a sell leaseback. So we'll go to a party, or they'll come to us and they say, look, we are willing to sell our asset and lease it back to you, but we want to lease it to you from you for 20, 25 years. And we want to be able to make all our decisions on the property as it relates to the viability of the property. That works well for our model. So we collect a rent check from them. We don't have to, we know that they're going to be there for a long time. They take that money, and then typically what they can do is they can reinvest that money into their business. So for example, they might be doing metal pressing. They can go take that money. They can buy 200-ton metal presses, build a wing onto this, and expand their business automatically, right?
Yep.
So I think it's a mutual win-win situation where they can get capital to grow or expand or recapitalize for some reason, and we get a very steady, stable tenant for a long-term basis.
Yep. So let me play devil's advocate here. I just read a story 2 days ago about a couple of companies that have been going around the country buying up hospitals. And similar story, they wind up giving this cash infusion to the hospitals, mostly rural hospitals. But then what's happened is those hospitals have squandered that cash, not really invested in things that improve their services or their assets. And now they're right back into trouble, but now they don't even own the property. So unfortunately, the way I look at it is there's these predatory managers, individuals, I think, who are, puffing up their earnings, and they're able to cash out and leave the mess behind them. I know that's not what you do, but can you kind of explain how, you've got that longer term view and you're in with these manufacturers?
Well, that risk that you talk about is what I attribute primarily to financial engineering. So at any point where you have someone who has an asset and you have cash and you want to exchange those for some sort of contract, there's a little bit of engineering that goes along with it.
Mm-hmm.
And you see that a lot in the sell leaseback space. And so having been in the space for a long time, we're very cognizant and aware. And so my point, to give you an example of this, if they want $10 million of proceeds and they're able to pay X dollars of rent, then the cap rate is the variable, right? Or if the prevailing cap rates are this and they want that proceeds, then their variable is the rent. A lot of times what you see is they will dial up the rent to a rate that's sort of unsustainable so that they can get more cash proceeds.
Right.
And then what they do with those cash proceeds is important. So when we approach any sell leaseback, what we're first looking for is, do we understand this industry, right? Give you an example. Last year, I think it was, I don't quote me on this, but I think it was like in Oklahoma. It was a 5-year-old manufacturing facility of luxury dog food, and cat food, and vitamins and shampoos.
Mm-hmm.
Beautiful building. Seemed like a good credit. But I couldn't tell you in a really hard recession, what would the demand be for luxury dog food?
Mm-hmm.
I know that if I had 2 Chihuahuas, I would probably tell you it's forever, right? I just started the masses of us. Is that going to have the pricing power, economic viability? I couldn't get my arms around. Contrast that to one of the tenants that we did buy, called Voltier, is a leading manufacturer of galvanized guardrails. right? So galvanized means there's low prevention of rust. The guardrails that we see on all our freeways, I don't care if you have a Tesla or a Ford F-250, you hit a patch of ice, you run into that guardrail, it's going to need to be replaced. 90% of the replacement budget is the Department of Transportation. These aren't going away. So I can underwrite that we still need guardrails. So that's the first thing. The second one is you want them to be a leading manufacturer. You want them to have significant market share. Because if there are 100 manufacturers of a product and you have 0.1% of that market share, you could get knocked out and be gone quickly.
Yep.
We want someone that has leading market share. And then the last criteria from a physical standpoint is, do they have all their business or most of the business in this facility? Because if they do, then they're not, if they, God forbid, they get weak and they have to go BK or bankrupt, they're not going to reject this lease because that's the goose that's still manufacturing their profits, right? So, and then from there, you want to make sure they have good sound credit. From what, okay, you've done all that. Then you set your rent that it's sustainable. You want the rent to be for this landlord the thing that they're not going to think about. Right? If they've engineered it where they had too much, they got $5 million rent and they could only really comfortably afford $2 million, then when times get hard, they're going to say, well, let's get out of this place. I've destroyed value. And if they did that, particularly just to get cash and then go take it away. So when we do a sell leaseback, we want to know what the money's going towards, right? If it's a family business it's estate planning and it's going from the parents to the children and they need to cash out some, okay, we understand that. If it's a private equity firm doing that, we're going to be very cautious because a private equity firm, which happened in these hospitals, is stripping those assets of all the cash they can. And so we're putting assignment language into these things that they have to maintain a relative covenant of leverage. These are the things that anyone can do to get around it. When you get greedy and you do bad deals, you end up having bad results.
Right. Yep. Yeah, which is unfortunate, you know.
Yeah.
Should be in you know, proper business that you're looking at the long term, but unfortunately there are those unscrupulous players who don't. But
there's people who underwrite optimism that isn't always there. I don't
that's true
I like to be optimistic, but I always work from the worst case scenario. Right.
Yeah. And what I really appreciate, just hearing you talk, your business method of learning about, you know, it's a manufacturing process you know nothing about, but you're able to look at the underlying business and determine, you know, is this something that I can count on being sustainable for the life of this lease?
Yeah, you know, kind of like a Warren Buffett approach where you want to just have, you know, he's like court furniture, siege candy. These things are just, they're viable. And by the nature of that, if you've got some manufacturer that's been manufacturing something, a lot of them, you know, dealing with plastics or metals or things like that. I think people forget because we spend all our time in front of these screens. And since the 80s, we've been in love with information and technology. And we get fearful because there's so much obsolescence in technology that we're like, well, what if you know, how many people I get? Well, what if we go to, you know, completely self-driving cars? I'm like, okay, well, we could, but there's components in there that are still going to be needed no matter what.
That's right.
And I think we forget that we live in a physical world and that there's physicality around us. And that if you don't have people who can manufacture and manipulate that physicality, then you don't have anything, right? We'd be sitting in grass huts. And so I think people forget that. And there's something there. So our properties are not high. They're not NVIDIAs. Right? They're not flying off the charts. They're durable, but that's why the rent matters. The rent has to be sustainable by them because they're not going to the moon. And even if they had tremendous sales, we don't get the benefit of that. Right? They're a stronger company, which is nice to have, but they're not giving us more rent. Right? Just because they're doing well. So we want durability. And I think that's, you know, that's something that's sussed out. I tour every asset that we go to because even if we've done all that stuff that I just talked about, we want to tour with the operations manager and see how the raw goods come in, how do they flow through, where, you know, how many shifts are they working, how much staff are they understaffed by, how many skilled laborers do they need, who are their competitors, what's their pricing, how quickly can they turn this inventory? These are all the types of things you really want to drill down because manufacturing is very specific. You could have two plastics manufacturers doing completely different businesses, and you want to know how efficient they are. And so you learn so much by touring the assets that you wouldn't get from a spreadsheet.
Sure. Yeah, absolutely right. You mentioned right at the beginning, talking about your background, and this came up on your last earnings call about, you know, you kind of come from that humble background, Indiana, working in West Virginia, and that really connected with me. I was born in West Virginia and grew up in middle of nowhere, Michigan.
Yeah.
And you talked about that being integral to Modiv's values. Can you tell us a little more about that tie?
Yeah. So setting aside the logic of, reshoring and underinvestment in manufacturing, which are all very logical, strong economic, strong value propositions, which is good for the intellect. There's also, what resonates at the gut or the heart. And for me, I've been in a lot of different asset classes and they never felt the way that this does. And I think I attribute it to, and I talked about it in our earnings release, from my background. So, I don't know, but I doubt there's too many CEOs of New York Stock Exchange listed companies who lived in a trailer in the middle of Indiana,
Right.
who literally as a young adult I worked at Wampler Longacre Chicken Factory in Moorestown, West Virginia. And I sat in the offal where I sorted through chicken guts to make sure knives didn't jam up the thing. I mean, I've had these jobs. I didn't have a silver spoon. Right.
Yeah.
And, I learned how to fix, ComNav and phase array radars for the Air Force in Mississippi. My dad grew up picking cotton in the summers in Arkansas. And this is just really, people forget about that is a large part of America, and particularly where this manufacturing is, right? The manufacturing facilities are across the places that are forsaken. They're not glamorous cities, but they're really good, hardworking Americans there who want to get ahead. And so that's what resonates to me. And it's like, we're making things. It's like, I could own $100 stores and there's nothing wrong with that. I could own 100 McDonald's. There's nothing wrong with that. But a lot of times that's just taking hard-earned dollars to consume. And we don't really need that. It doesn't necessarily make us better as an individual or as a family or as a nation. But hey, making something, being productive at the end of the day, to me, has a sense of value. And so it resonates at that level too.
Yep. Yeah. I mean, obviously you got a fan in me because I came from very similar background, and I've been advantaged to also see the other side of the coin. And it's not to disparage people who had it a lot better than me, but I do think there's a grounding that you get coming from that more humble background and understanding the people who do make the things that we need and do those tough jobs that, it really is just integral to America. So I applaud you for that.
Yeah, and look, we're all human, right? And we all have our own roots, and we all have our things. I think for me is that it resonates with me, and it's okay for it to resonate with me. Yeah. And it takes a village. And I think a lot of times we think about just the numbers, and it gets faceless. And there are faces with everything that we do.
Right.
Yeah.
Yep. Well said. All right. Well, we're running out of time. I did want to hit one last point, and that is, as you look to the future, we talked about your bullishness on manufacturing, but what is big for Modiv, looking at the next 5-10 years?
Yeah. So I happen to be the CEO, and if anyone doesn't know how the public companies work, is you actually have a board of directors that is elected by your shareholders, and they hire management. So I have a hired job, but I think of myself as investor, and I actually have taken a lot of my own substantial net worth, invested into the company. I'm probably the second largest individual shareholder out there, not the largest shareholder, but the second largest individual shareholder. So I think like an investor. And my view is, and this is my personal view, and this is why I put all my eggs in this basket, and I spend a lot of time focused on it, is we pay a nice, healthy monthly dividend that, depending on the day of the share price, is somewhere between a 7 or 8% yield. And we cover that dividend well. And that our share price, given where we've been in the last 2 years in the market, trades at a discount to what I believe is fair value, and that fair value is substantially more. And I believe that we're an investment class that the industrial manufacturing is going to have even more tailwinds than it's had. It's going to benefit from this, and we're going to hear about it more and more. And this is the unique way to get paid a dividend with potential upside in an asset class that takes care of the heartland of America. And I see the opportunity for us, because we are small. There's no doubt about it. We are not a big REIT, that we could quadruple in size and provide growth and still be an attractive takeout target down the road by a bigger REIT. And so the goal for us is to continuously produce dividends, to grow our share price, to invest in America, and make it to a sleep well at night investment. I treat the money that, I try to be as best I can of a steward of people's capital, and I view that this is hard-earned money, and it could be my grandmother's, it could be my mom's, it could be my dad's. It's this money that they don't want to risk it, but they want to try to make it grow. And so my job is to try to make it grow. I think there's a tremendous opportunity to do that. And that's what I'm going to keep plugging away at as long as I'm allowed to do so.
Excellent. Anything we haven't hit on here that we should know, or folks out there ought to know about?
I just think what you're doing is great. I think more and more people need to understand that manufacturing is real. It exists, and it's not all overseas, and that we should care. And then on the margin, we should try to get it back here because it provides us so many ancillary benefits that I think we as a nation have forgotten about.
Agreed. Well put. Excellent. Well, Aaron Halfacre, thank you for joining us today.
Jim, thanks so much for having me. Appreciate it.
And of course, as always, thanks to you and the audience. This is why we're here. So we're here at least every Tuesday, sometimes even more. I can't promise every show is going to be as educational as what Aaron brought us today, but they're all going to be educational, and they're all going to be that focus on manufacturing that Aaron spelled out so well. So thanks again, and we'll see you next Tuesday.
Be great.
So long.
Thanks for tuning in to Manufacturing Talks with Jim Benoski. Watch for new episodes dropping every Tuesday. And don't forget to like, share, comment, and subscribe.